At about 9 o'clock, we had a pink triangle come in and it called the top. Where is it? Well, maybe I get to 9 o'clock here. Right there. All right. So we got quite a bit of a rally in the first 30 minutes of this particular trade or session rather. And so when you're trying to pick a top either to get short or cover a long if you're long, this was your first indication that indeed it could be a top. So it trades sideways for a while and then comes off. Anybody that says, well, it went 3 ticks higher than it, you don't want to stay in a trade if it's going sideways. Meaning it's more and more risk it's going to come off and do this. Right? Don't try to be perfect. The other thing is it started going green. When it gets a green laser, it has a better chance of going down. When it gets a red laser in here, it has a better chance of going up. It went red to green in here and went side back to red, so up a little bit. Green down a little bit, red up a little bit, green down. So everything was in place that this was going to at least be a temporary top. And these are very objective tools. And like I said earlier before I started recording, when are you going to find a transition of getting into a trade or a bias, creating a bias? If it's green, it's bearish. If it goes green to red, it's bullish. And you see this, we went over this before I started recording for this particular highlight, but we see this happen throughout the whole session. The lasers are comparing how many longs versus how many shorts. If it's red, there are more shorts than longs in the last 2 minutes. If it's green, there are more longs than shorts over the last 2 minutes. Why is that important? Because if the market is short, like it is in here, it has the ingredients to go up. Because after you're short, you are now a buyer to cover that short position. So if there are more shorts than longs, there are probably more buyers than sellers. That's the imbalance you need for the price of anything to go up. More buyers versus sellers. Not just people who buy it, people who want to buy it, damn it. You have to go and if you're predicting upside. That means you're predicting more buyers at some point to come in the market. You're predicting them before you see them. Once you see it filled, everybody sees it filled. After, you're wet, it's too late predicting it's going to rain, right? You have to predict something that hasn't happened yet. I'm predicting buyers that you don't necessarily see yet. How are you able to do that? Well, positions. If there are too many shorts versus longs, that's where there's more buyers versus sellers. And round we go. But every tool that's used in our community is objective and based on either other people's positions or an imbalance between buyers who want to buy it versus sellers who want to sell it. Everything else, it's all surrounded on that premise, period. It doesn't have anything to do with a Fibonacci or a moving average or anything else other than just that. That's how we're getting support resistance, and that's how we're getting in a position to predict better. You got to be able to predict better. You're not going to get consistent unless you're confident. Confidence always, in my opinion, precedes consistency. Confidence, consistency. You're not going to get confident unless you have an edge.